Welcome to Trading Day. I'm Matt Scooby. Let's get to some stories that we are following in the BNN Bloomberg newsroom. U.S. President Donald Trump says he will not renew the Canada-U.S.-Mexico trade agreement and reiterated that the U.S. doesn't need anything that Canada or Mexico has to offer. The countries are facing a deadline of July 1st to extend the pact. Trump's comments set the stage for months or years of negotiations over rules and tariffs for key industries. If it is not renewed, CUSMA will stay in place until at least 2036 and will enter rolling annual reviews. The Bank of Canada kept interest rates unchanged at 2.25%. The weaker Canadian economy, U.S. trade uncertainty, and the ongoing war in the Middle East, keeping oil prices high, could warrant a shift in monetary policy. Governor Tiff Macklem says that shift could include further cuts or consecutive rate increases.
Economic weakness combined with rising inflation is a dilemma for monetary policy. Raising rates to dampen inflation could further slow the economy. Easing rates to support growth increases the risk that higher inflation becomes persistent. For now, holding the policy rate unchanged balances those risks. However,
Shares of Apotex are moving higher in its trading debut. The pharmaceutical company, now trading under the ticker symbol APTX, raised $1.3 billion in its initial public offering, making it Canada's largest IPO since 2021. The listing comes nearly a decade after the murder of founder Barry Sherman and his wife Honey. Apotex also is one of two firms approved by Health Canada in recent weeks to make generic versions of Ozempic. Let's have a quick check on the markets so far today. A lot more red. The tech pullback certainly evident once again on both sides of the border to the TSX. Down almost 0.4% here to start the day, about halfway through. Down over 135 points. South of the border, seeing the same, too, as we watch the technology stocks driving things still lower. A lot of yo-yoing with the AI stocks, too. So we're watching that, both the Dow and the NASDAQ, both down over a percentage point, at least for the day today. So we'll continue to keep a close eye on that. But we're going to begin with our top story, too, and U.S. President Donald Trump right now saying that he's not going to renew CUSMA. BNN Bloomberg's Brian Platt joins us now from Ottawa. So, Brian, at least for now, we understand it's maybe not necessarily a big surprise, as July 1st certainly is approaching very quickly. But take us through what we did hear from the president, too, as well as the implications of this now moving forward.
Yeah, so these are comments made as President Trump sometimes does. He holds these sort of freewheeling scrums with reporters in the Oval Office. So this is one of the questions that he took when he was in there. And he said the exact phrase, well, he made a few comments. So one of the phrases he used was, "I'm not looking to renew the trade deal." So it is important to understand what this means and what it doesn't mean. When this trade deal was negotiated in Trump's first term, it came with a July 1st deadline, July 1st, 2026. So that's coming up shortly, where all three partners could decide to renew the deal, in which case it just stays as is and keeps going, or you could enter a review period that could last for as long as 10 years. And so by not renewing on July 1st, the deal remains in force. There's no, we're not falling off a cliff here. But it does add to the uncertainty because now we're into this 10-year period of essentially rolling annual reviews. And I think that the way that this is actually going to play out now is, we know the U.S. has sectoral tariffs on steel and aluminum and autos and lumber. Those issues in particular, Canada wants to get to the negotiating table to sort out. And whether there's any other, whether it's changes to USMCA itself or maybe other, side deals that get done in addition to USMCA, that's really what we're going to be looking at now in the next few months. But for the most part, things won't change because the deal is still in place. All the exemptions stay in place. The only thing that changes is we know that Trump does not want to renew this deal on July 1st, which is basically what Canadian government officials already expected.
Yeah, Canada had made clear at one point that they do want to renew it. Mexico did the same, and they could have re-upped it for 16 more years. But Brian, as well, we heard from Bank of Canada Governor Tiff Macklem today, too. One of the main points, at least for right now, when it comes to the key interest rate, and at least for now, is the uncertainty about the U.S. trade situation. This in particular doesn't feel that it's going to hamper some of those concerns moving forward if we're going to get into annual reviews every year, in particular while Donald Trump remains president.
I mean, from what I understand, watching Governor Macklem answer questions today, this was basically the Bank of Canada's this was their base case already, that we were going to enter months of negotiations related to USMCA. I don't think the Bank of Canada, Tiff Macklem did not explicitly say this, but I don't think they were expecting Trump to renew this deal on July 1st either, right? So this is what the Bank of Canada already assumed. It does add to trade uncertainty, and so that could lead to softness in the economy, and it's where the Bank of Canada is still having a tricky time navigating this the weakness in the economy alongside very high oil prices from the Iran war and how that all plays out. So it doesn't change anything in the short term, I guess, put it that way.
Mm-hmm. Bloomberg's Brian Platt. Appreciate this. Brian, thanks so much for the update.
Thank you.
Well, the market's outlook has shifted dramatically in recent months. Strong economic data, stubborn inflation, and rising energy prices have forced investors to reassess expectations for a Federal Reserve policy. Now, some market participants are now pricing in the possibility that the Fed may not cut rates at all this year, surprising enough, but could even consider raising them right now. Joining us to discuss more, Michael DeHull, Senior Portfolio Manager at DeHull Investment Partners. Michael, thanks for being here.
Thank you for having me.
We're going to talk about Bank of Canada clearly a lot this afternoon, but the Fed in particular, I think, right now, surprising that we are now in this position. You look at all the other indicators that have been coming out, and now it's not cuts, now it's multiple possible hikes here at the end of the year. Give me your thoughts, where we stand.
Absolutely right. You've seen the CPI numbers come out this morning, a 3-year high with U.S. CPI at 4.2%. So any talks about a cut that we had for the last, call it 18 months, it's pretty much off the table. So now investors are looking at, the best case, a hold or even a hike later on this year, right? Especially if inflation persists and it continues higher.
What surprised you the most about the resilience of the U.S. economy? Are there parts in particular? Because, again, there's a lot of different, you get into this, there's a lot of those different ones that we've been watching. What surprised you the most?
What surprised me most is the consumer. Consumer spending has been resilient in the U.S. In face of the war, higher prices, consumers continue to spend money on goods and services, right? And that's been a great surprise for us this year going into 2026, as well as U.S. GDP growth. We're seeing trend line above 2% growth. So when you have high persistent inflation, good even economic job numbers as well, right? Unemployment is at 4.3%. Last week they reported robust job growth, right? So all those economic indicators points to more of either a hike or a pause for this year.
Is there a threshold, do you feel, though, for that consumer spending? Let me just, nail down a little bit on that for it. As we talk about the uncertainty with now Kuzma and the latest news on that, but the oil prices, the war in Iran still, right, the Middle East not going anywhere. Where is the threshold, do you feel, for consumers? Is there one? Because the impact of tariffs as well doesn't feel like that's going anywhere now anytime soon.
Absolutely right. I do think if this continues longer the war continues, longer oil prices remain elevated, it's definitely going to broaden out the inflation. Right now, we're seeing it more in oil and gasoline prices. But the longer the war continues to move forward into months ahead, we could see inflation broaden out into other areas such as food, shelter, services, and other goods. And that could provide a headwind to consumer spending.
I want to ask you too about the Fed, and go back to the Fed here just for a second too. Is that the biggest risk now to equity markets as we watch what's going to happen here? We're watching some of the sell-off right now and what's happening in particular for tech and the last few days, last maybe almost week here in particular. But now as the Fed slowly starts to shift its position, likely here this month, watching that for the rest of for the latter half of this year, how is that going to affect equity markets?
Absolutely. The biggest risk for the markets this year is interest rates, right? You're seeing the 10-year bond yield a couple of weeks ago hit 4.7%. It's drifted down to about 4.5%, but we are starting to see that creep higher. The 2-year is kind of a gauge where the Fed's going to be in 2 years' time. That has been rising. So as bond yields continue to elevate, you could see that risk premium, disappear in the equity market. So people are not going to be paying up higher valuations for these tech companies that have, 100 times PE ratios and all that, right? That can come back down to earth a little bit, right? As rates remain elevated and rate cuts are off the table, and we could see rate hikes later this year or into 2027.
Yeah, how many do you think? Like, and what are we looking at right now? It's hard to clearly. I'm going to ask you to look at your crystal ball a little bit, and I know it's very hard to predict. But if everything stays strong and all those indicators right now that we have seen, then surprising to a point, how many hikes could we see through the end of this year into maybe the first half of 2027?
You could see if inflation persists to go higher. We're at 4.2%. If that creeps up to, say, 5% or even, let's say, a six handle on inflation, you could see 1 or 2 rate hikes later this year, right? So it could happen pretty fast with inflation, right? We've seen that back in 2022 when inflation in the U.S. hit 9%, and we had all the subsequent rate hikes, right? So right now it's a very fluid situation. Obviously, the labor market's really strong in the U.S. at 4.3% unemployment. GDP growth is still robust. So all those factors obviously doesn't warrant a rate cut, but we could remain on hold for the remainder of the year. But inflation is definitely a wild card. If that goes higher than 4 and get into the 5-6 handle, you'll probably see some multiple rate hikes later on this year.
Right, and again, a lot of the price of oil too, and the price of energy, right, is going to dictate that, right?
Yeah, absolutely. And remember, a lot of oil prices or energy prices are factored into other prices in the inflation equations, right? Right now we're seeing in gasoline, but we could see it persist in other areas such as food, shelter, services, and things like that, right? And there's only so much companies can pass on or absorb in their margins until they got to pass it on to the consumer.
Give me your thoughts on AI. A lot of yo-yoing still right now and where things stand, but are we going to watch this drop and this sell-off still continue for the next little bit or what?
I think it's more repositioning than a shift in the narrative. I still think AI is a dominant theme. I still think we're in the early innings of AI. You're seeing build-outs, data center build-outs, AI infrastructure build-outs all across the world, right? So I do think this is kind of, AI trade is taking a bit of a breather. Remember, from the end of March to now, we had 9 consecutive weeks up until last week of S&P gains, week-over-week gains, right? And driven primarily by AI. I think the semiconductor index is up 100% since the lows of March. So is a breather warranted? Of course it is, right? But it's not going to change the narrative of AI. It's definitely, we think these are buying opportunities in certain stocks within the AI sector.
Yeah. Michael, appreciate your time. Thanks for being with us today.
Thank you.
This is Michael DeHall, Senior Portfolio Manager at DeHall Investment Partners. Well, coming up, the Bank of Canada holding rates steady for a 5th consecutive decision. We're going to get more reaction on that after this. Stay with us. The Bank of Canada announcing earlier today that it's holding its benchmark rate steady at 2.25%. The decision widely expected by economists across the board because of rising inflation and a softening of the economy. For more reaction, we welcome in Claire Fan, Senior Economist at RBC Capital Markets. Claire, so certainly, again, not unexpected, I think, today, too, but take us through, some of those indicators and what we heard from Governor Tiff Macklem in particular about today's hold.
Sure. So, Matt, like you said, the decision itself is hardly surprising in any regard. And this is really one of those meetings in between the Bank of Canada monetary policy meetings or monetary policy report meetings where they kind of outline their base case economic projections. So I think heading into this meeting, the key questions, there are 3 that we were expecting, not so much in terms of, the current stance, but relative to what they had outlined back in April. And those set of economic projections, what really has changed? And that questions pertain to what has changed in terms of their assessment of the current state of the economy. What has changed when it comes to their judgment for how oil prices has impacted the economy? And going forward, what has changed in their forward guidance? And the answer to all 3 of those questions is not really much has changed.
Right. And I think that's the thing. There wasn't a lot of, indicators, I think, for now, at least for the governor. What may have changed, Claire, too, the news today, and not necessarily it's going to impact what happens moving forward, but Donald Trump saying that the U.S. is not going to renew CUSMA. It's not going to happen by July 1st. It still feels like, listening to the governor's comments earlier today, that was expected. The bank was certainly felt like at least for now, that's what they're anticipating. But do you, do you see it another way, or do you see it again for now moving forward? That's going to continue to have the same, even driving that uncertainty for U.S. trade, forward for the next 6 months to a year.
Yeah, for sure. So the current reality is there's an incredible amount of uncertainty when it comes to the trade agreement, as far as, and then there are certain sectors, especially in manufacturing, for example, auto manufacturing, aluminum production and producing, although to a lesser extent. So employment in these sectors tend to really rely on demand coming from the United States. So there are soft corners that are really sort of, seeing a lot of pressure from foreign trade policy. But at the same time, when it really comes to CUSMA and the review process, I think really our base case forecast was really similar to the Bank of Canada's, which is that it likely will remain status quo going forward for the rest of this year. And I think the bottom line really here is that if, an agreement to extend the agreement is not reached by July 1st, then that doesn't mean the agreement itself and the related exemptions go away immediately. In fact, they will remain for the next 10 years, so the true expiration date. So really the decision here is to extend the agreement beyond the date of 2036. If you were to actually look at some of the actions from, let's say, USTR when it comes to their recent Section 301 investigation, so these are the tariffs that are, based on forced labor allegations, and they are set to or potentially replace the current Section 122 tariffs. In the annex, again, CUSMA exemptions were kind of upheld and really prevailed. So I think time and again, it really is the continuing sort of preservation of CUSMA agreement and those related exemptions that's giving us still some confidence that, at least as for the near term, for the remainder of 2026 and likely 2027, not a lot really is going to change despite a lot of headlines that are going to come out of the review process.
Mm-hmm. What about oil prices and the price of oil energy right now too, Claire, and where things stand? Because Tiff Macklem was asked a number of questions about it as well. The conflict in the Middle East continues, at least for right now, regardless, I think, of what the U.S. president says. So where and what impact does that have here as we watch those rates, and what could we see come the fall?
Yeah, for sure. So I think when it comes to oil price shock or broadly supply shocks, like the oil price shock that we're seeing today, it really does come down to the very sort of well-telegraphed growth versus inflation trade-off that's putting global central banks in a really difficult position, including the Bank of Canada. But in Canada, the Bank of Canada, as far as today's sort of press conference goes, did seem a bit more focused on the inflation side as opposed to sort of the growth side impact. So on the inflation side, essentially, and this is really the same message, again, coming from their April meeting, is that they will be looking through the near-term impact of higher oil prices on energy inflation. And that is really intuitive because essentially when it comes to central banks, they can't really influence, let's say, the outcome of the Middle East conflict. So they can't really have an impact through monetary policy changes on global oil prices. What they are concerned about, however, is sort of the downstream. For example, if we start to see pressure start to build in some of these non-energy components, kind of permeating of that oil price pressure start to spread and become more persistent. So those are really the trends that the Bank of Canada is more concerned about. And so far, again, Macklem kind of made it very explicit that they haven't seen early evidence of any of that yet. Mm-hmm. So that is just to say that so far, still watching out for inflation risk, but not overly concerned about it to a point that they need to raise rates.
Before I let you go, do you agree, because we heard Governor Macklem say that he expects growth to resume in the second quarter, that there are some early indicators that we are going to see some more growth from things that were stagnant in Q1. Do you agree with that assessment or not?
Yeah, so early, again, monthly prelim GDP tracking, especially sort of the early advance estimates, have been quite revision pro and quite volatile in the past couple of months and quarters. But nonetheless, the advance reading for April itself is a pretty big increase on a month-over-month basis. So by itself implies growth again in the second quarter. But I think more important for the Bank of Canada's decision really is the concept of the so-called output gap, which is where is that growth relative to the potential growth rate in the Canadian economy? So the bank has been pretty explicit in today's meeting that they do expect the Canadian economy will stay in the state of excess supply meaning that there is slack in the economy that will put downward pressure on inflation. That's really consistent with our base case forecast that, the runway to the next Bank of Canada interest rate move, which we're expecting some hikes in 2027, it's going to be pretty extended. We are really not seeing the bank moving, in the upcoming quarters.
Claire, appreciate your time today. Claire Fan, senior economist at RBC Capital Markets. Well, up next, U.S. President Donald Trump says Washington is not looking to renew CUSMA. We'll have a look at how that might impact Canada's economy. U.S. President Donald Trump says he is not looking to renew CUSMA, adding that the U.S. doesn't need anything from Canada or Mexico. Let's get some more reaction. Ed Devlin, founder of Devlin Capital, is here to discuss more. Ed, thanks for being here.
Thank you for having me.
Let's give me your initial reaction. Not entirely, I don't think, a surprise to anyone who was watching closely for what was going to happen from the American side, as much as Canada too and Mexico were trying to have some of these negotiations a little bit, and pushing towards the fact that they both wanted to renew it for 16 years. But give me your thoughts on the impact that we are going to see of what Donald Trump had to say today.
Well, I think the impact is, minimal. There'll be a short-term reaction as we're seeing in the markets. But, because, Trump doesn't have a whole lot of credibility with regards to his day-to-day statements, whether it's trade or war or whatever. So I think the markets are, becoming accustomed to it and are looking through it. That being said, it's a huge deal. I mean, trade policy for Canada is, so significant. I mean, we're in a recession. It's mainly because of Trump and his trade tariffs and the effect through the confidence channel. And if we can't get some resolution to it, it's, as the Bank of Canada said earlier today, it's definitely a headwind to the Canadian economy.
Yeah, and I think that's the biggest thing in moving forward too, right? Is that there was, the hope that we were going to see a little more certainty, but now we're going to have, not just, the deal is going to be there. So you mentioned no short-term impact, but now we're going to have rolling annual reviews. And while Donald Trump remains in the White House, it feels like that is going to limit what the Canadian economy can do. Do you lean that way or not?
Well, definitely a headwind. I've been thinking the Canadian economy is a little weaker than what the Bank of Canada thought for a year or two now, and probably more in line with the Bank of Canada now. But it's the thing about it is watch. It'll be interesting to see post the U.S. midterm elections, how much Trump becomes a lame duck or not. Because as your previous guest was just talking about, these are rolling things, and the U.S. Supreme Court has limited the amount of illegal tariffs he can do. Don't underestimate his ability to come up with new illegal tariffs and then just use the court system to run out the clock. So there's a lot of uncertainty ahead, as Tiff Macklin, said today, but. It's not like hair on fire, crisis mode, but it's definitely not positive.
You talk about hair on fire too, and when it comes to prices in particular, at least right now, we have the inflation that's rising, in the U.S. and also, here in Canada too, and particularly look at the data from last month. Though, when are we going to see prices go up again, or when do we get to that maybe not necessarily hair on fire level, but where does that concern, threshold remain for you based on this and what we're looking at for the rest of this year?
So I think the number one thing that both the Bank of Canada and those of us who are investors are looking at is, are we going to see, energy prices and the supply chain disruptions that are driving up headline inflation CPI feed into core CPI and therefore feed into investors' expectations of inflation in the future. And that's the most nefarious part of an inflationary cycle. And I think that Paul Volcker, the chairman of the Fed way back when, 70s, 80s, created the model that I think Tiff and Warsh will follow, which is when you're dealing with stagflation, when in doubt, fight inflation. And so you're seeing them both be very cautious on the inflationary side, be willing to put, as Volcker did, the economy into a recession in order not to get that really nasty inflation cycle. And I think both the Bank of Canada and the Fed have done a pretty good job of signaling to the market, and I think the bond markets have broadly respected their guidance.
And for you too, and you bring up recession as well, and Tiff Macklem was asked about that as well today, and he doesn't believe that the Canadian economy is there, and talk about technical recession and where or whatnot. What's, where do you land, at least for that right now? You'd mentioned that you believe the economy in Canada is weaker than the bank and maybe, has hampered some of those expectations. But where do you believe it is right now? And are we headed that way, or is it still going to depend on where we could end up recession-wise?
I think it's really hard to make a forecast like 1 year forward on growth because we do have some big variables like the GDP report that was weak. A lot of it was unexpected lack of spending by the government. We did have a good employment report recently here in Canada. I think one of the biggest things we're looking at is artificial intelligence and AI, which could be quite disinflationary. So right now, when you look at the inflation numbers, it's goods and commodities that are going up, and services are going down, mainly driven by a weak labor market and possibly the implementation of artificial intelligence. And I think that is, so there's a lot of variables here that I think I wouldn't be so arrogant as to try to tell you exactly what's going on. I think we just have to watch the markets and the economy very closely. So that's why I think that the Bank of Canada's wait-and-see policy is prudent.
Ed Devlin, founder of Devlin Capital. Ed, appreciate your time today. Thanks so much for this.
Thank you so much for having me.
Well, coming up, we're going to continue our coverage of the BOC rate decision. We're going to talk about what holding means for mortgages when we come back. Stay tuned. U.S. President Donald Trump says he will not renew the Canada-U.S.-Mexico trade agreement and reiterated that the U.S. doesn't need anything Canada or Mexico has to offer. The countries are facing a deadline of July 1st to extend the pact. Trump's comments set the stage for months or years of negotiations over rules and tariffs for key industries. Now, if not renewed, CUSMA will stay in place until at least 2036 and will enter rolling annual reviews. The Bank of Canada has left its key rate unchanged at 2.25%. Governor Tiff Macklem says economic weakness combined with rising inflation is a dilemma for monetary policy. He reiterated that the central bank may need to cut or hike rates consecutively, depending on how risks unfold, citing that U.S. trade uncertainty and the war in Iran. The BOC notes, however, that while growth appears on track to resume in the second quarter, it expects the economy to remain in excess supply. Well, shares for the Northwest Company are trading down today. The Canadian grocer and retailer reporting lower than expected results in its first quarter. Sales fell 1.5% compared to the year before, while adjusted profit also saw a decline. Comes as a federal food voucher program comes to an end. The change caused consumers to spend less. Northwest services mainly remote northern and indigenous communities. Let's have a look at the markets, too. So far today, still a fair amount of red on the board as, again, the tech sector continues to lead the downward trend. The TSX in Toronto down almost 0.5% today, over 150 points, at least for right now. The AI stocks have been yo-yoing. They've been the darlings for quite a while, but we've been watching, again, the red and the drop that we have seen on both sides of the border. On the U.S. side as well, oil prices are up too slightly, but some significant declines, and some of the markets reacting as well to that news. Maybe not as significantly as we have seen in the past, but the latest words from Donald Trump too, that CUSMA is not going to be renewed. The NASDAQ down 1.5%. Dow Jones flirting with that as well after we saw those record highs last week. Well, the Bank of Canada is holding its key interest rate at 2.25% as it weighs oil-driven inflation with flat GDP growth. Here to tell us how the decision is impacting mortgages is Ron Butler, mortgage broker at Butler Mortgage. Ron, thanks for being here.
Thanks for having me.
Give me your overall sense of, not a surprise today, I don't think, from Tiff Macklem and what the bank decided to do, but give me your thoughts again, just initially about what we heard from her today.
Absolutely no surprise. And the Bank of Canada governor summed it up quite well. It's a dilemma. We've got pending inflation based on lack of oil supply, war in the Middle East, and counter that with lousy economic growth for the last little bit. So yeah, they really have a dilemma, and obviously their decision is just to sit and watch for the time being.
Mm-hmm. And feels like it's going to be, for moving forward as well, that at least for now, we'll see. But you also talked about the hikes and the possibility of cuts too. Where does that factor in for mortgages too right now? Because there's already, you talk about uncertainty for a lot of homeowners in this country right now, having to renew, having to get back into it. But what are your thoughts as that uncertainty now looks like it's going to persist through the end of this year?
I think people react to mortgage situations as they are. And right now, there's a big gap between fixed rates and variable rates. So when we have 75 basis points of gap, then we tend to see a trend toward variable, and that's what we're seeing. I believe today, if we surveyed banks today, they'd tell us that about half of their new mortgage issues are variable. So that's quite a trend from maybe 2 years ago. It was about 15-20%. So variable is the product of choice right now.
And you believe that is the right move for homeowners right now that are looking to renew at this point, or what are your thoughts there?
My thoughts are that people are very tempted by 75 basis points less rate,
right.
And I don't blame them. I mean, we've got an affordability crisis in Canada. When people get a renewal, the rates go up, the payment goes up. They'd like to see a way to keep it down if they can. So you can't assign any blame. Is it the absolute right move for the future? We don't know. If the Bank of Canada governor doesn't know, it's pretty tough for mortgage holders to know, right? So yeah, we could see some inflation that would push the rate up. If we get the war over with, we could see some inflation reduction. It's a tough call. I sort of lean towards the idea if you can get a great fixed rate, like a rate that's below 4%, you might want to grab it. That's probably the conservative, wise thing to do. But I think there'll still be the temptation to take variable.
Yeah, Tiff Macklem also touched on housing in some of his comments today too, right? And where the market stands too, that he's saying it's going to be a little bit more stable, says it hasn't, or at least the bank is expecting it to be a little more stable. How that affects inflation, how that, factors into their next rate decision, we'll see. What are your thoughts about the housing market, I think in particular right now, and what we're seeing across the country?
Well, it's interesting. We have some lousy results in British Columbia and Ontario. There's a slight pickup in sales in Ontario, but still pretty wobbly. Prices continue to drift down year on year. But there were all-time highs in some provinces. Like provinces like Quebec reached an all-time high. Alberta was buoyant. Calgary's a bit down right now and may continue down. But the thing that worries me, if some provinces are at all-time highs, maybe they're gonna roll over too. So we could have some more weakness in the housing market.
And how is that a concern again, for you, at least getting into the rest of the economy, and also in particular for first-time home buyers? People that are looking to get in, a lot of them have been waiting for moments it feels like this, and maybe that's why we're contributing to some of those all-time highs, people getting into the market for the first time, because they were waiting for a break like this after we saw, what was rampant and just the wildness that happened during the pandemic.
100%. And, those chickens are coming home to roost. People who paid exorbitant prices in 2021, I mean, some of those markets are off as much as 35%. For others, it's not so bad. Like I said, Quebec, they're doing great. But the reality of life is that there's still some more room to fall in house prices. And if you're a first-time buyer and you don't feel the pressure to buy, you might just want to keep watching. The rate is something that can go up and down. It changes. You can take a 2-year, you can take a 5-year, you can take a variable. You can have options. But if that house price is going to go down another $50,000 in the next 6 months, you're better off with the lower house price.
If you do have a mortgage right now, you're in that position where you have to renew right now. We talked about some of the banks pricing in, a lot of people that can't afford it, that aren't there. You talked about the affordability crisis as well. Where do we stand right now, at least from your sense, in regards to that? People who are just can't afford it, they have to be moving on, and not necessarily defaulting on mortgages, because we know that's been up certainly in the last 6 months in particular. But where do we stand for that, and how is that going to affect the market here for the next the remainder of this year as well?
Again, it's regional. The GTA is the most impacted. We've had the most growth in mortgage default. It's up to 41 basis points, which doesn't sound like too much, but in 2020 it was about 12. So that is a pretty fair jump. I think we're going to continue to see those problems happen. To your point, there's just a point where you can't stretch your dollars far enough with other types of inflation going on. So I see it as a problem that will grow, not probably as fast as it has, but it will continue to be a problem.
And at least for right now, too, we get, at least at this point, and we get into some of the mortgages and some of these, it's a psychology thing, isn't it? Right? It feels like that. We touched on it maybe a little bit earlier, too. But for people, whether you're a first-time home buyer, whether you're trying to, remain in the house that you're in right now, it certainly is a psychological decision about whether you're looking at 75 basis points or not. But just the ramifications from that can be, make their way right through, whether it's your personal decision, but what we're seeing in the economy, too.
It's 100% correct. If more people choose to wait it out, if more first-time homebuyers choose to wait it out, that's a problem for builders, and that's a problem for construction workers. So your point is quite well taken. What is good for parts of the economy may be bad for the others.
Right. And for mortgages now, as we get into it, and you said that variable is the way to go, but tell me again, under 4%, you would do fixed?
Yeah.
Is that out there right now at all, or not really? Is that realistic?
It's very hard.
Yeah.
You got to shop like crazy. There's a few specials available. For instance, if you're buying a house with less than 20% down, there is a 399 5-year fixed available right now. It's out there. Grab it if you can get it. Mostly, though, it is 419, it is 429, it is 449. So those are higher rates. Variable it's just 75 basis points less. And, if you're willing to dedicate yourself to carefully studying the market because it has an inherent risk, it's not a bad bet.
Right, and that's going to be the thing. You have to stay on top of it if you're in a variable mortgage, or else things can go sideways very quickly.
Variable is definitely not set it and forget it. It's you're going to have to commit to watching it almost every couple of days.
Yeah, very, very true. Okay, Ron, appreciate your time. Thanks so much for being here today.
Thanks very much.
It was Ron Butler, mortgage broker at Butler Mortgage. Well, coming up, Apotex raised $1.32 billion in Toronto's largest IPO since 2021. We're going to get into the details of that after the break. Stay right here. Apotex Health share is opening 17% higher in their trading debut today after the company raised $1.32 billion in Toronto's largest initial public offering since 2021. For more, we're joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. So, Jeff, now down, I think, about 12% for the day so far, but certainly a very big day for the first time for this stock to be traded. Take us through, again, why it is so significant, to be on the markets.
Yeah, you bet. So this is one that ECM bankers have kind of been trying to get out there, and a lot of market watchers have been waiting to see it come to market for quite a long time. So in some ways, the wait is over, the anticipation is here. The stock opened about 17% above where the IPO priced. So this was a stock that bankers have been trying to sell to investors at somewhere between $20 and $24 a share in kind of the marketing rounds. In the end, it ended up being $24 a share, and it was so well subscribed that they actually upsized it, offering more to investors. And then when the market opened today, it opened at 28. So fair bit of upside there. It has paired some of those gains. It's now only up about 12%, but that's still significantly better than what we've seen from some other IPOs over the course of this year. For example, AGT Foods was up, or when they came to market earlier this year. Had a bit of a rougher first day of trading. Same thing with Lumina Metals, but a little bit flat. So 17% or 12%, I think the company will probably take that. As you mentioned, this is the biggest IPO in the Canadian market since 2021 when Definity Financial came to market. And that was at a period, too, when there were a lot of companies coming to market. 2021, 2022, the Canadian marketplace set some records in terms of total number of deals, and so we have seen really a pretty sharp slowdown since that period. So now to see such a big IPO here in a period where we've seen maybe a few deals a year for several years in a row, a big deal, and that's partly why investors have been watching it so closely and why I think a lot of ECM bankers are so happy to have it out today.
Yeah, hey, it does feel that way too, right? It feels like it's been a while since we've talked about a big IPO like this. Are there any concerns, Jeff, too, with SpaceX? I know it's south of the border, it's the U.S., and I get it, but you talk about all the coverage, and clearly investors not too spooked yet about what's happening with other IPOs, but you touched on the other ones. But, give us a sense of where things stand for that, in particular for SpaceX, what we're going to see at the end of the week.
Yeah, so I mean, it is interesting that this IPO, they managed to kind of get it out before the SpaceX IPO, which is coming at the end of this week, and maybe that's good. It does seem, too, like investors are really eating this one up. So, I suppose that's potentially a source of relief. Worth noting that the difference between the Canadian market and the U.S. IPO market over the last few years is the U.S. IPO market had already seen kind of a sharper rebound in terms of activity than the Canadian market had, and so you're right, SpaceX is coming to market, potentially OpenAI, potentially Anthropic. So you have a handful of these big major deals. But that's also on the back of a market that has seen a number of other tech and tech hardware deals, as well as a market where the tech and tech hardware space has been almost completely parabolic. So in speaking to a few fund managers on the street, there are slightly more concerns about the narrowness of the rally in the U.S. and the concentration of the rally in those tech stocks, and whether or not potentially investors are going to sell some of the winners in tech to buy these new potential winners in tech. In terms of whether or not the Canadian market has been kind of overtapped, I don't think that is a concern that I'm hearing so far. I think probably a lot of ECM bankers and maybe a lot of investors are pretty pleased to see a deal of this size come to market today and be received kind of the way it is. Whereas, as you say, SpaceX is coming this week, and that is going to be a huge one in the U.S. market, where I should also note, not an IPO, but we've seen Google tap the market in a huge way last week with I think it was $81 billion. So these are huge new offerings coming into the market. We're not really seeing as much of that in Canada, but it is worth noting Canadian investors do participate in the U.S. market as well.
Yeah, exactly. So, but certainly some good points. Bloomberg's Jeff Morgan. Jeff, appreciate the update today. Thanks so much for this.
Thank you.
Well, still ahead, we're going to take a closer look at the potential impact of the Gordie Howe Bridge on trade. Stay with us for that. Once the Gordie Howe International Bridge is open for business, several sectors will benefit from the ease of crossing back and forth across the bridge, including truckers carrying Canadian goods. CTV's Adrian Gabriel looks into that aspect of trade between Canada and the U.S.
Spanning 2.5 kilometers across the banks of the Detroit River, the new Gordie Howe Bridge has sat idle. That is about to change.
It's been 25 years in the making. I'm happy to hear this.
The old Ambassador Bridge has been the busiest along the Canada-U.S. border for years. More than $390 million in trade traverses the route each day, representing 26% of Canada's exports and 33% of all imports by road. Here inside CSA Transportation, freight is moved into hundreds of big rigs that cross into the United States every day with increasing difficulty.
It's expensive, really, really, really long lineups, so it's caused delays in moving freight cross-border.
How important is another border crossing, another bridge for your industry?
Trucks that are crossing the border, it won't be as long waits. It'll be cost-effective for them, and if it's more cost-effective for them, then that passes on to the consumer.
Detroit and Windsor, Ontario have been bound by two automotive economies.
There's $100 million worth of auto parts that goes across that bridge in either direction every single day.
The president of Canada's Auto Parts Manufacturing Association shares his belief that the new bridge will remove a bottleneck at the border with more direct routes to market.
The route to this bridge is in from a highway, out to a highway. Anytime you can improve those processes in public infrastructure, you're winning.
For the mayor of Canada's automotive capital, the pending opening is a victory years in the making.
Being able to have certainty in crossing the border is imperative for this auto industry and parts sector to work seamlessly. It's going to be great for commerce, great for community.
The consensus among multiple industry leaders we spoke with is that shorter wait times at the border and cheaper tolls should deliver savings for Canadians. Adrian Gabriel, CTV News, Toronto.
Let's have one last look at the markets before we let you go. Again, things a lot of red across the board today. The TSX down over 100 points right now. We've seen some losses in base metal, technology stocks today, offsetting some of the gains that we have seen in the energy sector as the price of oil moving higher over the course of the day today. South of the border, too. S&P 500, NASDAQ, both also down. The NASDAQ down over 1%. A little concern over the conflict in the Middle East as President Donald Trump vowing some more threats to attack Iran after in more retaliation as well. So that's it for now today. We're going to be back with you tomorrow. See you then.